Hey everyone, I decided to do my opportunity on FASB Codification 80550, specifically the section related to pushdown accounting. I decided to do this because the section in the book on pushdown accounting was pretty short and I didn't really understand it very well. So I decided to master this subject and hopefully you'll be able to learn something too. So we'll start with some background information and then move into a problem which we will solve. First, what is pushdown accounting? From the FASB glossary, pushdown accounting is the use of the acquirer's basis in the preparation of the acquiree's separate financial statements. When is pushdown accounting applied? From the FASB guidance, an acquiree shall have the option to apply pushdown accounting in its separate financial statements when an acquirer, an entity or individual, obtains control of the acquiree. I found the textbook definition helpful as it's more specific. As a general rule, the SEC requires pushdown accounting when the ownership change is greater than 95% and objects to pushdown accounting when the ownership change is less than 80%. What was the purpose of this update? From the FASB Accounting Standards Update number 2014-17. Current generally accepted accounting principles offer limited guidance for determining whether and at what threshold an acquiree can reflect the acquirer's accounting and reporting basis in its separate financial statements. The objective of this update is to provide guidance on whether and at what threshold an acquired entity that is a business or nonprofit activity can apply pushdown accounting in its separate financial statements. How does pushdown accounting relate to partnerships? According to my research, pushdown accounting primarily affects limited partnerships. From the FASB documentation, master limited partnerships are partnerships in which interests are publicly traded. The formation of a master limited partnership subsections, which are included in FASB 80550, identify specific transactions involving master limited partnerships and provide guidance on whether pushdown accounting is appropriate. How is pushdown accounting applied? Shown here are required information to evaluate the effect of pushdown accounting. This is required in disclosure on the financial statements. More importantly, pushdown accounting is applied through journal entries, which we will be looking at next. Before we get started on the actual problem, I quickly wanted to show you where I found the problem from. I found the problem from Farhat's accounting lectures, and this particular video is easy to find on YouTube. Now we can get started on solving the actual problem presented in the video. First, let's set up the scenario. P Company acquired an 80% interest in S Company on January 1st, 2015 for $2,200,000, at which time S Company had capital stock of $1,500,000 and retained earnings of $500,000 for a total book value of $2 million. The implied value of S Company is $2,200,000 divided by 80%, which equals $2,750,000. The difference between the implied and the book value is allocated as presented below. Important to note here is that the values here in this right column are the implied values that will be used in our pushdown entry. And we will see these values being used as we make the journal entry on the next tab. So here we have the accounts already set up. Inventory in the scenario under the implied pushdown base equals 50,000. So we can set up a formula across the sheet and it'll pull that number. Then I can drag down for each of these and it'll do the same thing. Here, revaluation capital is the term used in pushdown accounting for the difference between implied and book value. The total amount here in the scenario is this $750,000. So we will pull the full amount as a credit to revaluation capital. And the purpose of this entry is shown here: to record pushed down values as a result of the purchase by P Company. Remember, S Company is now using the acquirer's basis for their separate financial statements. The other entries shown here are workpaper elimination entries, which we will see as we go through the statements. Here on the income statement, I would like you to draw your attention to the cost of goods sold, which is highlighted in red. This figure has changed as a result of this journal entry, because the value of the beginning inventory changed as a result of pushdown accounting. Also of note is this net income line, which will be pulled onto the retained earnings statement. Here on the retained earnings statement, we see some elimination entries and also a blank net income line. This is because I wanted to show you how to pull from one tab on a workbook to another. So we want the net income from this tab to go here onto the retained earnings statement. It's very simple. An equal sign, and we'll click into the other cell. Then I can grab the handle and drag across, and it'll fill. Drag all the way across. Okay. And that's it for the retained earnings statement, as nothing except for the net income pulled from the income statement would be affected by pushdown accounting. Here on the balance sheet, we will perform the same procedure to get the retained earnings line highlighted in yellow. I also want to draw your attention to the accounts highlighted in red. These accounts were also affected by pushdown accounting. For example, land, in the journal entry, increased by $150,000. This is reflected here in the financial statements. The same is true for equipment, and the same is true for goodwill, which was created as a result of the difference between implied and book value. The final thing to note here is revaluation capital, which is included in the stockholders' equity section of the balance sheet. This is the effect of pushdown accounting, as the difference between implied and book is allocated to this account, revaluation capital, and shown here on the balance sheet. Then it is eliminated when the eliminating entry is made to eliminate the investment in S Company. I hope this was helpful and that you learned something new today. Thanks for watching.